Thank you very much, and we'll touch base with you after the numbers. Yeah. Neeraj Gambhir, the Group Executive at Axis Bank, is also with us. Neeraj, before I come to the budget, just parse the global environment for us. The chairman has said something, the Fed chairman, that he's pushing out the rate cut further down, quite emphatically, so it's not in March, but the yields have reacted lower. All told, what's the take for India?
So clearly, I think we are done with the rate hiking cycle at US. I think that's the affirmation that Chair Powell has made. And they're looking at the opportunity to start rates, but they don't seem to be in any rush to do that. And hence, the pushing out of the expectations of rate cut from March down the line to maybe May or June. I think May would be a live sort of committee for that. I think one of the things that has happened in the recent past is the fact that US yields have actually inched down quite significantly from a high of about 5% to now down to about 4%, a little lower than that. And that has resulted in a significant amount of financial easing. And my view is that one of the reasons why they have kind of tried to push down the expectations to May or June is that they did not want to trigger a further round of financial easing in the markets because there is still concerns about whether this level of inflation is sustainable. And he mentioned that whether we will settle down at this or a higher level of inflation. So I think inflation is pretty much at the center stage at this point in time, and they will look to see at least 3 or 4 data points before they get fully comfortable about starting to cut the rates. But the next step is a rate cut is something which is kind of sort of affirmed in this policy.
Okay.
And that's what the long end of the market seems to be reacting to. The long bond yields in US have actually gone below 4% after the policy. I think markets seem to be taking comfort from the fact that now indeed the rate cutting cycle should start sometime soon.
Yeah, fair point. And there's of course a bit of a regional bank issue over there with some results not coming into good. But Neeraj, we have you on a slightly shaky line. We'll just set that right. Take a quick break and come back. Lots more questions for you on the budget and the market borrowing program. In a bit, we are also going to be joined by Mr. Sudhir Kapadia, the partner, tax and regulatory services at EY, and Sunil Badala, the deputy head of tax at KPMG. We'll be discussing tax angles with them. Stay tuned. Welcome back. We are continuing our special coverage on the union budget, actually the vote on account that's due anytime now. We have been speaking with Neeraj Gambhir, the Group Executive at Axis Bank. He heads Treasury there. Neeraj, you told us about the global environment and how we should parse it, that the direction clearly is yields are getting lower. But more importantly, on the budget itself, would a 5.5 upset the bond market if the fiscal deficit were higher? What kind of a market borrowing is the market prepared for? And what may be good, what may be bad?
So, Latha, in terms of absolute fiscal deficit number, I think we should see consolidation. Now, whether it is 5.3 or 5.5 is a matter of debate. But I think anything less than 5.5 will be a good number for the markets to sort of parse. In terms of borrowing numbers, gross number in the range of about 15.5 lakh crores and a net number of about 11.5 lakh crores is what the market seems to be sort of thinking at this point in time. So this will basically keep us at the same level as last year. And therefore, I think it basically means that from supply side, there is not likely to be any adverse shock in the next fiscal year. Again, this is a vote on account, so these are interim numbers. So there will be some tentativeness to these numbers, but if this is broadly the range, then I think market should be okay. Anything less than that in terms of borrowing program, and there is some expectation that given the fact that small savings have been doing very well, whether that could allow the government to actually look for a slightly lower borrowing number. If that materializes, then obviously it's a big positive for the bond market.
So actually, basically what you're saying is no negatives and perhaps one big likely positive if the borrowing number is lower. I mean, if it is higher, we don't mind because there is going to be big FPI buying. And if it is lower, it's bonus. So only upsides now for the bond markets likely. Is that the way to look at it?
That seems to be the case. I'm expecting that the borrowing numbers will not go up. They will either stay the same or they'll probably marginally come down.
The FX market needn't bother at all about the budget? Nothing over there for them?
Well, I think it depends upon what the policy is, and if we see a good cheer in the equity market, and that results in some of the outflows that we've been seeing in the equities from FPIs, if that reverses, then obviously that's a bit positive for the FX market as well. But that remains to be seen how the market takes the budget outcome.
Anything at all that the budget can do about the tight liquidity that is bedeviling the banking system? The Reserve Bank has been giving money through repos, but clearly NBFC stocks are impacted. Everyone's impacted. Banking stocks, all of them reporting lower margins because of a high deposit cost. Can the budget impact this in any way at all?
So one of the key things that we would like to see in the budget is what is the cash balance that the government is expecting to carry forward from March to April. At the moment, the government is sitting on a fairly high cash level. I think in the month of December, it went up to as high as about 5 lakh crores. It has come down some bit because of the expenditure and some bond redemptions. But if the cash balance numbers are high, that basically means that this liquidity is unlikely to be spent going into the March. And this is, the last quarter of the year, and therefore there is a lot of focus on deposit growth and borrowings, etc. So if liquidity eases because the government is spending, and hence Reserve Bank doesn't need to do as much of intervention in the short end of the market, I think that will be positive, and that could have some soothing effect on the money market rates.
All right, that's important. Thank you very much, Neeraj Gambhir, for telling us what to train our eyes on, and have a good day yourself. So bond markets really don't have much of a downside here. There is only a possible upside if the borrowing is even less than 12 lakh crore. And of course, if the amount of cash that they have on their books is less for the current year, that will also be positive.
Absolutely. Well, Latha, all